Take them in.
I mean, like where you're, where there's a whole bunch of people.
Okay.
I don't want one on me because I use it. That's why
I mean, that's perfect.
I know me. I'm too hot.
Some of them have been shot all the time.
I used to be real rah-rah.
I'd be out on the highway, it's gonna be cut me off. I don't need that in my life. Sometimes you gotta know yourself, right?
You gotta know your back.
All right. So interest paid over the life of the loan. We kind of talked about this earlier to some extent. We used that silly example of, that we had a $1,000 loan and it was being repaid at $100 a month for 12 months, and we just said, well, 100 times 12 is 1,200. That's the same thing that happens with mortgage loans. You're going to see test questions where they want to know how much interest has been paid over the full life of a loan. And they're going to give you a bunch of information that you don't need, like the interest rate. You don't need the interest rate. What you need to know is the payment. You need to know how much the monthly payment is. Because all you're going to do is take that monthly payment and multiply it times 12 months a year, times whatever number of years the loan has been issued for. It's a 15-year note, and you multiply times 15 years. If it's a 30-year note, you multiply times 30 years. Because what you're ultimately trying to do is total up how much has been paid total on the loan. Does that make sense for everybody? You know how much you're paying monthly, so just take that out to yearly, and then multiply times the number of years, and that'll give you the total paid over the life of the loan for interest and principal. So like here's a quick example. What's the total principal and interest paid over the life of a 30-year mortgage loan issued at 5% interest with monthly PI payments of $1,074? Well, I'll tell you what we don't need. We don't need this 5% interest rate, because that's already been taken into account with this monthly payment that they just gave us. Does that make sense for everybody? So we're paying $1,074 a month, 12 months a year, times 30 years. And that's what this math is right here. For a grand total of $386,640. And that's total principal and interest. Now that's not really how the test questions are going to be, because the test questions aren't going to ask you for the total principal and interest. They're going to ask you just for the interest portion. But if we've got total principal and interest, what one more piece of information would you need to calculate just the interest piece? Well, purchase price or loan amount, right? We need to know the loan amount. We need to know how much was borrowed, because once you take that out, the remainder is the interest. Does that make sense for everybody? Okay? And so remember, we pay the interest first, we pay the principal second. They're just the two things combined. So if you wanted to take that question to the next logical step and say how much of that is just interest, we need to know what the loan amount was, and they've given it to us now. What's the total interest paid over the life of a 30-year mortgage loan of $200,000 issued at 5% interest with monthly PI payments of $1,074? Well, we take that total PI payment, $1,074, times 12 months a year, times 30 years. That's the $386,640, minus the $200,000 principal amount. So the difference is our interest. So over the life of that 30-year loan, we would pay $186,640 in interest. That's an ugly number. And folks, that's at 5% interest. What if it's at 7%, 8%, 15%? My parents' first mortgage was at 17% interest. 1972.
Is there a cap on mortgage rates? In the car business, some people they stay caps with like 22.
Right. It's called usury caps, right? Yeah. So the same usury caps apply to mortgage loans that apply to car loans, but mortgage loans have never gotten that high. It's never been an issue on the mortgage lending side. So you're not going to see 29% rates. So if you see 29% rates on the mortgage side, you need to find another line of work, because you won't ever sell anything if you get 30% interest on a mortgage loan. So, but yeah, so even at 5% interest, because you're amortizing that thing over such a long period of time, there's still going to be a whopping amount of interest that gets paid on a loan like that. Is everybody okay on that? All right. So then let's go back over to your worksheet. Take the worksheet back out here. And let's work through some of these others. Number 18 says Carlos wishes to borrow $10,000 at 7% annual interest for 10 years with monthly principal and interest payments of $116.11. How much will he repay in total once the note's paid off? So they're not asking for the interest, they're asking for the total repayment.
That's PI total. So what are we going to do here? 116.11 times 12 times how many years? 10 years. $13,933.20. Okay, so that's a total of $13,933.20. And then the follow-up question is, in the question above, how much interest will Carlos pay over the life of the 10-year note? What would we do to calculate that? Subtract the loan amount. Take the total principal and interest, because we calculated the total up here. So the total of $13,933.20 minus how much did we borrow in the first place? $10,000. So in interest, Carlos would have paid $3,933.20 in interest. Everybody okay on that? Speaking of Carlos, there was out the window. Here. It really is Carlos. That really is. It really is. He works in the office next door, and I was reading a question with Carlos. I'm like, wow, there's Carlos right there out the window. He heard his name. Okay. Number 20, what's the total interest paid over the life of a 15-year loan for $50,000 that's issued at 6% annual interest rate with monthly PI payments of $421.93? So this is much more like a test question would be. They want to know the total interest paid. Well, we can't get the total interest paid until we get to the total that's paid overall, right? So what's step one going to be here? 421.93 times what? 12 months a year times 15 years. That's $75,947.40 in principal and interest, but they only want to know the interest piece. So what are we going to do? Subtract out what? Subtract out the principal, which is $50,000. Is everybody okay with that? So we want to subtract the principal out of that, get rid of it, and that is $25,947.40 in interest. Now that, of course, assumes he keeps the loan for the whole 15 years, makes every payment exactly on time, doesn't make any early payments. You know, that's how much interest he would pay. Okay? 21 says if Sam's offered a mortgage loan at 5.5% interest and purchases 3 discount points, what will his new rate be after the points are applied? Well, when we talk about discount points, how much does a discount point cost? 1% of the what? Of the loan amount. That's exactly right. 1% of the loan amount. So, we're buying 3 discount points, right? 3 points equals 3% cost. But that's not what they asked us for. What did they ask us for?
What will his new rate be? So we're not dealing with the cost. What are we dealing with?
The rate change. Does that make sense
For everybody? How much does each point change the rate? 0.125 times how many points? 3. So that's 0.375. Now does a discount point raise or lower the interest rate? Lowers the interest rate, so we're at 5.5 and we're going down by 0.375. So what's our new rate going to be? 5.125? Does that make sense for everybody? So the new rate is 5.125. Okay? Yes? No?
Yeah, no, I was thinking 1/8, which is the 1/1.
Right. So you could also say 3/8, right? Because if you did 3/8, type 3 divided by 8 in your calculator, it's still going to be 0.375.
That's what I did.
Yep. You can do it that way as well. All right, number 22. How many discount points would be required to buy an interest rate down from 6.25 to 6? So again, we're dealing with the rate change, right? How much does each point change the rate? 0.125. How much did the rate change? It changed 0.25. Couldn't we divide that by how much each point changes it to figure out how many points are necessary? Does that make sense? So we change by 0.25. We divide that by 0.125 because that's how much each one changes. How many points do we need? 2. 2 points. Another way you can do this, if you struggle with knowing what the math step there is, another thing you can do to help yourself with that is you can simply say something like this. You could just write yourself a little chart over here on the side. 0.125, 0.125, 0.125, 0.1. You can make this, right? You could just, and if you add them together, what is 0.125 plus 0.125? 0.25, right? Plus 0.125 is point what? 0.375 and 0.5. And you can just keep going up. So if you know the 0.125, you can always go up. And in other words, when you see the change is 0.25 right here, how many points did it take to do that? 1, 2. Does that make sense? So you can do it that way too if you want to. Because it's always going to be like, it's going to be less than 8 points. It's always going to be like, 2, 3, 4, 5 points. It's never going to be something like 72 discount points. It's never going to. That's figure out how many points it would need to change the rate. Because each one changes the rate 0.125. Each one costs 1% of the loan amount, but it changes the rate 0.125. Just remember, they charge you 8 times as much as they lower your rate, right? They lower your rate 0.125, but they charge you a full 1%. Okay? Number 23, Ariana's purchasing a home for $418,000 and obtaining a 90% loan-to-value fixed rate 30-year mortgage with annual interest rate of 5%. She's decided to purchase 2 discount points to lower her rate over the life of the loan. What will she be charged on the closing settlement statement for the discount points? So, when you talk about what somebody's going to be charged on the closing statement for their discount points, how much does each discount point cost?
1%.
Right. 1 point equals 1% of the loan amount. Does that make sense for everybody? How many points are we buying here? So 2 points equals what? 2% of the loan amount. Two percent of the loan. Now, how much is the loan? We don't know that yet, do we? Can we figure it out? 418 times what? Times 90% loan to value. That is 376, 200 for the loan, times what? 2%. 2%, because the charge for each discount point is 2% of the loan amount. Okay? So 376, 200 times 2% equals $7,524. That's what they would be charged for those 2 discount points. Not you, huh?
Yeah, at least.
Okay, is everybody good? All right, number 24. Leslie wishes to purchase a property in Clayton and is obtaining a $215,000 5-year interest-only loan, called a term loan. But and the interest rate is being offered by the lender at 5%, but Leslie wishes to buy the rate down to 4.25%. What's the total charge to Leslie on the closing statement for this fee? So they want to know how much the fee is, right? So when you think about fee, you should think about each point costs how much? That's not what it costs.
1%.
It costs 1%. Think of it. You pay 8 times more than what it changes. It changes the rate by 0.125. The borrower gets the short end of the stick. The 1% is the lender's side. The 0.125 is the borrower's side. Okay? So each point is going to cost 1% of that loan amount. Okay? So how much is the loan? $215,000. Well, times 1%, each point's going to cost $2,150, right? Does that make sense? That's for 1 point. Now, does she probably need more than 1 point? You think she needs more than 1 point? I would say so. How do you know she needs more than 1 point? Look at how much the rate needs to move. That's a lot more than 0.125, isn't it? Okay. So, how do we go about figuring how many points it would need? First thing we need to know is how much we need to move this rate. What are we trying to move it from? 5 down to what? 4.25. Can we subtract those and figure out what the difference is to see how much movement we need? Okay. So we need to lose 0.75% here. And we're going to lose it in what kind of increments? How big are the increments? What is each point going to change that rate? 0.125. So what are we going to do with this? Divide it by 0.125. Divide it by 0.125. And how many points is that? 6 points. And how much did we say 1 point costs? 1% of the loan, which we already figured out over there, is $2,150. So couldn't we just multiply that times 6? $12,900 up front at closing. Non-refundable.
Can't change it.
That's right. Well, you can, but they got your money. They'd actually love it if you change your mind at that point. That's right. That's exactly right. Are we okay on that? So when you talk about discount points, you need to know how many points and you need to know a loan amount. Sometimes you have to combine the two. All right? All right, I want you to go ahead and do numbers 25, 26, and 27. Actually do 28 as well, and 29. All right, so 25 through 29. 449. 449. And those of you that bring a book, maybe a neighbor will be nice enough to let you look. I think everybody's got at least one at their table. Here's 5.5, right? And I want to go to 15. This is 15. So how much is it? Yeah.
Is that 445?
449. 449. stuff.
The number's right, that's why I did it. Just making sure. So
553. Should we go in the book? It's 553, right? 30 year, 553. 553. So you did the math right, but it's 553, not 560.
Oh, yeah, down on.
Rest is right. Did the math right, but the loan factor goes down.
Oh, you can search.
All that goes to the monthly payment. I don't have to tell me this. Why are you doing that? What's any of that going to do then? Calculate the monthly payment. Why are you going out to annual interest and all that bullshit? What's the chart? What? That's payment, right? Per what? So how many thousands did you borrow? So just multiply those two numbers together and there's your monthly payment. Not 50,000. How many thousands? 50. There's your monthly payment. That's it. Stop. I don't know what you did. I mean, that's the thing. And that problem is you don't know what you did either because you're just throwing them.
I had it right here, so you see.
I see you have the number, but that doesn't help if you don't know what the number is. That's my point. Yes, that is the number, but you've got to recognize that that's what they're asking. You know, all that rest of what you were doing. You think a monthly payment's going to be $62,000 on a $50,000 loan? That's right. Okay. So, again.
5.5.
That's the loan amount. Yeah. No. Much. 588,000. This is 258. No. There's your monthly payment. That's your monthly payment. That's all you need. All the rest of that is borrowed. There you go. Here, you did the right thing. 12 times 30, 82. They don't want to know what the total of the principal and interest. They want to know what is the
But if it's interest, this is principal and interest. What do you have to do? They're already at it. They want to know just one. It's like PI. PI. What do they want to know?
What's the interest paid?
They want just the interest. That's right. There's the interest. Same thing here. You got the total paid, but you want to know just the interest. No.
I have a question. 28 and 20 similar?
It's 28 and 27. Well, let's look at 27 and 28. I've already looked at everybody's 25 and 26. Right? What's right here? All right, so let's look at 27. 27 says we want to calculate the monthly PI payment. Some of y'all went so far off the reservation it ain't even funny. You're doing math again, and that's what I told you earlier. Remember when I said that thing you said you would never mess up? You messed it up because you get so deep in your own skull and you think you have to use every number they give you. You don't. What does that chart give you? It gives you the monthly payment, right? But it only gives you the monthly payment in $1,000 increments. So all you need to figure past that is how many thousands you're dealing with. Does that make sense? Okay? So, on this question, you look at the chart, you find the payment is $5.53 per 1,000. How many thousands are we borrowing? How many thousands are we borrowing? 288. So that's the number we multiply by to get our monthly payment of $1,592.64. Does that make sense? Okay. We are borrowing 288 blocks of money. We're not borrowing 288,000 blocks because they're in $1,000 blocks, right? Think of how many, if you were stacking them in $1,000 blocks, how many blocks would you have? How many stacks would you have in front of you? 288 stacks. And that's what you need to multiply by. You need to multiply by the number of stacks, not the total number, but the number of stacks of money. Because that payment already assumes that you bought, it's not a payment per dollar, it's a payment per what? Per $1,000. Okay? So don't multiply times $288,000 because it's already assuming that you borrowed 1,000. So you just need to multiply times 288. Are we with me so far? Okay? So then on number 28, you need to combine. Well, you don't actually combine on 28. 28 is what's the interest paid over the life of a $100,000, 30-year, fixed rate, 4.5% mortgage with monthly principal and interest payments of $506. They're asking you for what? What are they asking you for?
Interest paid over the life.
Interest. What they gave you is a payment that combines what two things? Principal and interest. So in order to figure out how much of that is interest, you need to get what out? You need to get the principal out. So the first thing you got to do is figure out what's the total you paid for the whole thing. And you pay it in monthly installments of $506. So $506 times how many months a year? 12 times how many years? 30. That's a total of $182,160 that's paid over the life of the loan. But that's principal and interest combined. What do they want to know? Just the what piece? Just the interest piece. So you have to take the principal back out, subtract the $100,000 that you were loaned. The interest is $82,160. Okay?
Yeah. I did the math right on 27, but I used the wrong number.
You had the wrong number from
Yeah.
the chart?
Yeah.
That's easy to finish, right?
Yeah.
Okay. How we feel about 28? Everybody good on 28? And then 29 is basically just repeat of question 28, except with a different monthly payment and a different term, right? Now the monthly payment is $739. We're still making it 12 months a year, but instead of 30 years, you're paying for how many years? 15 years, which is a total of $133,020.
subtract out the $100,000 that you were loaned, and that's interest of $33,020. Everybody okay with that? Now, look at question number 30. What is the difference in interest paid over the life of the two loans in questions 28 and 29? This is the last step for finance math. This is the last piece you could possibly be asked. To compare two loans. Didn't we just figure the interest paid over two loans? Number 28, we figured a loan, and we basically took the same loan in number 29 because it was the same $100,000, right? One's a 15-year note, one's a what? 30-year note. And they're at different interest rates because they usually will be at different interest rates. This question wants to know, basically, how much interest I save by going the 15-year rate or note versus the 30-year note. Does that make sense for you? So what are you going to do here? You're just going to subtract the two. You're just going to take the interest you pay on the 30-year, subtract the interest you pay on the 15-year, and that difference is your answer, 82,160 minus 33,20 I get a savings or difference in interest of $49,140. Everybody agree with that number? So here's how you would explain that to a buyer or borrower. Trudy, you can get a 30-year note and you'll get a 4.5% interest rate. Or you can get a 15-year note and you get a 4% interest rate. Now your payment's going to be $233 a month more if you go the 15-year route. But you will save $49,140 in interest by getting the 15-year note. Pretty significant savings, isn't it? So for an extra $233 a month, paying it off in 15 years rather, you can pay it off in 15 years rather than 30, and you will save $49,000 in interest. And that's a very real, I mean, those are real numbers. You looked up the loan factor, so that's a real number comparison right there. Does that make sense to everybody? Okay. So for your homework, I want you to finish this packet. Okay. That's going to be your homework, is to finish this packet. All right, and I'm going to flop back over here to the slides, and we're going to finish up chapter 14 before we take our lunch break. We're almost done with chapter 14. Chapter 14 is a slog, sort of like chapter 7 is. Everything in 7, 7, 14, 21's closing the transaction, so it's just about as bad. So yeah, I guess the 7s are the bad chapters here, multiples of 7. Loan repayment, or different types of loan repayments. You need to know these for the test, because you're going to see them. You might not have to identify them necessarily, but you will see them, so you have to know what they are to recognize them. When we talk about different loan repayment types, we're talking about how the payments are structured, how the monthly payments are structured. The most common is the fixed rate. So what does that mean about the interest rate? It does what? It stays the same. It never changes. Fixed rate, fully amortized loan. And what does fully amortized mean? What is amortization? Doing what? That's a definition from yesterday. What does amortization mean? It includes the principal and interest, but that's not the definition of it. Amortization is financing something with scheduled payments over time, paying it down over time. So what does fully amortized mean?
Down to zero.
That you pay it down to zero. Perfect. That's the perfect answer. Fully amortized means you pay it down to zero. Means you've been loaned the money for exactly the amount of time that it will take you to pay the debt off completely. Does that make sense for everybody? So, with a fixed rate, fully amortized mortgage, that means the interest rate will never change, and that when you make your last payment on that note, the day it becomes due, the day the note matures, how much do you owe? Zero. Your last payment takes you down to a zero balance. You make 30 years, 15 years, whatever the term is, worth of payments, and you'll have a zero balance. That's fully amortized. Not all loans are fully amortized. Okay? You need to understand that. They're not all fully amortized. Remember yesterday we talked about the fact that they could be partially amortized. Does everybody remember that? Okay? So, you're not going to ever see a rate change. And then down here at the bottom, this last note, it says the borrower begins to build equity with the first monthly payment. What did we say equity was? Give me a definition of equity. It's the opposite of debt. I'm going to help you out. So, what is equity? Everybody struggles with this definition. So here's your assignment for this week. Come up with a definition that you're comfortable with for equity. Because if you can't define it, you can't pass the test. Because it's going to get used in every finance question imaginable. What is equity?
What it's worth minus what you owe.
What it's worth minus what I owe. It's my take of the property. If I were to sell it, it'd be the amount of money I would have left over after I paid off the what? The debt on the property. That's the equity. So with a fixed rate, fully amortized loan, you start to build increasing equity with every single payment. Every payment takes you closer to having it completely paid off. Does that make sense? What is your equity at purchase? Your down payment. Your down payment's your equity at purchase. Good. Interest-only loans are also called term loans. Well, the name interest-only should give you some idea of what's happening here. What is happening with an interest-only loan? The payment is covering only what? The interest. So what's happening to the principal balance? Staying the same. So this is not an amortized loan because you're not paying it down. It's staying the same. Are you going to have a balloon payment at the end? Yes, and how much is that balloon payment going to be? The full amount you what? The full amount you borrowed in the beginning because you never touched the balance. You're only paying the interest that accumulates monthly on the loan. Why would you do this? See, that's the thing. In finance, the first question you should ask about these loan types is why? What's the advantage? Why would I do this rather than a fixed rate, fully amortized loan? There's only one advantage.
It's cheaper month to month.
Cheaper payment. Lower monthly payment. If I'm only paying the interest, is the payment going to be more or less than if I'm paying a fully amortized payment? It's going to be a lot less. The fully amortized payment is the most expensive loan payment you can have because you've paid it all the way down to what? To zero. What does partially amortized mean? You've paid it down, but not to what? Zero. So is that payment going to be more or less than a fully amortized payment? Less. Is it going to be more? Is partially amortized going to be more or less than interest only? More than interest only. So basically, if you wanted to rank them, fully amortized is the most expensive monthly payment. Partially amortized next, and then what? Interest only all the way at the bottom. So the advantage, the reason somebody would do an interest-only payment is to, or an interest-only loan, is to get the minimum possible monthly payment. They want to get into the property. Stop thinking about only houses. I know that's what you're doing, and you'll never get there. Nobody does an interest-only loan on a house. What if I bought a shopping center that had an interest-only loan on it? And after I paid the interest-only loan, I still had a before-tax cash flow of $100,000. Would it be worthwhile to own the shopping center even though I'm not paying the mortgage balance down? Of course, because I'm doing what? I'm making money off of it. You see that? It's not about paying it off. When you get in commercial real estate, I've told you 1,000 times, these loans don't matter. What matters is the cash flow. Are you with me on that? They don't care what the debt is on the property. They don't care if they ever pay it off. What they care about is the cash flow that it generates on a month-to-month basis. And Are you gonna have a better cash flow if you're making an interest-only payment versus a fully amortized or partially amortized payment? Because the debt service is gonna be lower, right? It's a lower monthly payment. There's where your interest-only loan comes in. Everybody okay with that? Adjustable rate mortgages, you're certainly gonna see those on the test. You're gonna see a significant amount about adjustable rate mortgages. The name implies it all. What can change or will change? Not can, but will change. The interest rate. Now, they don't adjust daily. They adjust at regular intervals. Usually, we're going to talk about those intervals. Usually you'll have like a 2-year arm. Well, a 2-year arm means the rate can change every what? 2 years, right? Now, so the other thing is that the rate almost always adjusts which way? Up. Otherwise, folks, you wouldn't get them. What's the draw of doing an adjustable rate mortgage? Why do people want them? What's lower? Why is the payment lower though? Why is it lower than a fixed rate mortgage? Because the interest rate's usually lower when? In the beginning. That's why we call it the teaser rate. It's called a teaser rate. The why of an adjustable rate mortgage is they get it because the initial interest rate, the one at the beginning, is lower than what they can get on a fixed rate loan. Nobody would ever take out an adjustable rate mortgage if they could also get a fixed rate mortgage at a lower interest rate. Does that make sense? You only consider the adjustable rate if you either can't get a fixed or the fixed you could get is at a much higher rate than the adjustable you could get. Does that make sense for everybody? Okay? So with adjustable rate mortgages, the changes, the adjustments are usually going to be tied to something in the stock market. We call them publicly traded indexes. Like you can go look up the prime interest rate, for example. And it changes from day to day. Your interest rate on an adjustable rate mortgage will be tied to some publicly available index. And what happens is when you hit that date for your adjustment, you go look at it, and the loan will say, your interest rate is going to be prime interest rate minus 6%. Everybody with me? So on the day your adjustment hits, you go look up prime interest rate and it's 13%. That's the prime rate for the day. So your contract says your adjustment rate is going to be prime minus 6%. What is the interest rate going to on your loan? 7%. You got a 7% loan now. And you'll be locked in until the next adjustment cycle, whatever that happens to be. If you've got a 1-year arm, then it can change every what? 1 year. Got a 2-year arm, it can adjust every 2 years. A 5-year arm would adjust every 5 years. Everybody okay on that? Okay? These are very common in commercial real estate. There's no such thing as fixed rates in commercial real estate. Almost everything's adjustable in commercial. They are certainly done in residential as well, but they're very common. Now, something you need to know, these two terminologies you need to be very familiar with for the test when it comes to adjustable rate mortgages. Most adjustable rate mortgages have a couple of different caps on them. One is a good thing, the other is a terrible thing. And the one that sounds good is the one that's terrible. A payment cap is a horrible thing on an adjustable rate mortgage. Here's why. What does a payment cap sound like? It limits how high your what? Your payment caps out. It can't go any higher. Everybody's like, oh, that's great. But guess what's not capped? The interest rate. If you have a payment cap, is it possible that the interest rate could continue to adjust upward and to a point where the interest that's accumulating is more than your monthly payment? Yes, and you would only be paying that lower amount because the payment cap has you capped, but the interest is way up here and the payment is capped down here. What does that mean your loan balance is doing? It's growing every month because you're not even covering the interest that's accumulating. Does that make sense? So a payment cap is not a good thing. Yes, ma'am.
So this is, it's a cap on what they're billing you, not what you can pay.
You can certainly pay more if you'd like,
Okay.
but on what they're billing you. But the problem is, we know that the vast majority of people, what do they pay?
The bill.
That minimum amount due
Well,
that
there
comes
was-
in.
what was it? We were talking about earlier where you were only allowed to pay a certain amount
if you had a prepayment penalty clause?
Yes.
Well, yeah, adjustable rates will never have a prepayment penalty clause, yeah. Okay, but does that make sense for everybody? Now, an interest rate cap is a wonderful thing to have on an adjustable rate mortgage, because what an interest rate cap would do is cap how high the interest rate itself could go. Doesn't that also serve to cap the payment, right? So you'd rather see, so be very careful when you take out an adjustable rate mortgage, when you look at the caps, does it call it an interest rate cap or does it call it a payment cap? Which one would you rather see? The interest rate cap. You understand the difference there? Because that payment cap can result in what we call negative amortization. Negative amortization is when the payment does not even cover the interest that is accruing. Those were very common in loans that were made to subprime borrowers during the build-up before the mortgage meltdown in the 2000s, having adjustable rate mortgages that had payment caps in them. And the lenders sold the payment caps as a wonderful thing. They would say to somebody, oh gosh, yes, it's an adjustable rate, but honey, you don't need to worry about that. Your payment is capped at $1,300. No matter how much that rate goes up, your payment will never go higher than $1,300. And it didn't. But what they didn't tell them was that there was $3,000 a month worth of interest accruing on that thing. And they were only paying $1,300 a month. What was happening to that interest? It was being added to the loan balance. And then the next month, you owed even more interest. And the payment was still capped. So you get further and further behind, faster and faster. What could go wrong? Go wrong with a system like that, right? It was a very popular feature, particularly in a place like California. We talked about the fact that the initial rate, the beginning rate, is usually called the teaser rate because it's usually what? Abnormally what? Low. It's there to tease you in. And eventually that rate's going to reset upward over time. Okay? They're going to adjust upward over time. And that's it for chapter 14. Finally, right? It's tough. It's a lot. It is a lot. All right, so let's do this. Let's take your lunch break and come back at 1 o'clock. Okay, come back at 1 o'clock, and then we'll do chapter 15.